Welcome to Know What You Are Investing podcast, where we decode the world's top companies. In this episode, we analyze TSMC's third quarter 2025 earnings. We will review financial performance, data center demand, advanced technology production, and insights from management and analysts. Let's get started. Welcome to Know What You Are Investing podcast, where we decode the world's top companies.
What they do.
How they grow.
Oh, why it matters.
Okay, so today we're doing a really focused deep dive. We're looking into TSMC, Taiwan Semiconductor.
Yeah, the linchpin, right? The absolute core of the AI supply chain everyone's talking about.
Exactly. And that label, it's not just hype. We've got the Q3 2025 earnings report, the call transcripts.
And they really show why TSMC's earned that title. I mean, this wasn't just a good quarter. It was a record smasher, blew past all the expectations.
Right. So our goal here is to get past those headlines. We want to dig into the actual numbers, look at the tech that's driving this.
And really unpack their huge investment plans, because they're gearing up for what they themselves are calling explosive AI demand. It's pretty incredible stuff.
Let's kick off with just the scale of this beat. Revenue for Q3 2025, US $33.1 billion.
That's massive.
And think about the growth that's up over 10% from just the previous quarter and almost 41% from last year. Way ahead of what they guided.
It's huge, yeah. But what really jumped out at me beyond the revenue was the profitability. Gross margin hit 59.5%.
Wow.
Yeah, their own guidance was, 55.5 to 57.5%, so it hit nearly 60%. That's just phenomenal, especially with all the money they're spending on expansion.
So what was behind that? Was it just selling more chips or something else going on?
Well, it was a mix. Definitely the volume and, the type of chips, those advanced ones, that was key.
Yeah.
But they also got some nice tailwinds.
Like what?
Like cost improvements, they mentioned that. And a big one was the exchange rate. They managed NT 29.91 cents to the US dollar.
Okay.
Their guidance was based on NT $29. So that difference, that more favorable rate, it added a really significant cushion to the bottom line. Pure profit boost.
And that feeds straight into net income, right? Yeah. Which was also strong. Diluted EPS, NT $17.44. That's up 39% year over year.
Yep. And their balance sheet, just solid as a rock.
Yeah.
Ended the quarter with NT $2.7 trillion in cash and equivalents. Operationally strong, too. Inventory days ticked down a bit, 76 to 74 days. Shows things are moving, especially those N3 and N5 chips.
N3 and N5 being their most advanced nodes currently shipping in volume.
Exactly. And even while paying out dividends, they still generated positive free cash flow, NT $139 billion. They're essentially funding their own giant expansion projects.
Okay, let's dig into that technological engine. You don't get numbers like this just by selling lots of stuff. You need serious tech leadership. What's the core driver here, nanometer-wise?
It really is all about the nanometers, or what TSMC lumps together as advanced technology. In Q3, that segment, 7 nanometer, and anything smaller made up 74% of their total wafer revenue.
74%?
Yeah, and that's basically the heartland for high-performance computing, HPC.
And just to remind everyone, HPC means the chips needed for AI, machine learning, big data centers, that kind of heavy lifting.
Precisely. This is where TSMC has incredible pricing power. And if you break down that 74% further, the mix is really telling. Okay, so N5, the 5 nanometer family, that's still the biggest chunk at 37%. It's a mature high-volume node now.
Right.
But N3, the 3 nanometer stuff, that came in at 23%.
23%. Already. That feels really fast for how new it is.
It is fast.
Yeah.
It speaks volumes about the demand, right? From the big phone makers, yes, but increasingly from all those AI chip designers needing the density and power efficiency N3 offers.
So it shows customers are absolutely willing to pay the premium for N3.
No question. It validates TSMC's strategy. And the last bit of that advanced bucket was N7, 7 nanometer, still significant at 14%, still a workhorse node.
Okay, so the tech story is clear, but we often hear it framed as just an AI story, all about HPC. HPC-led, sure, 57% of revenue. But did anything else grow? Was it just data centers buying everything?
That's a key point. No, it wasn't just HPC. And this is where you see maybe a broader recovery taking shape.
Interesting.
Yeah, look at the other platforms. Smartphone revenue would jump back sharply, up 19% just from Q2, making up 30% of the total.
Okay, a smartphone rebound, what else?
IoT, Internet of Things, that saw a huge 20% sequential jump. And even automotive, which is usually pretty steady, That grew 18% quarter over quarter.
Right, so growth across the board, really.
Exactly. So the takeaway for you listening is, yes, HPC and AI are massive drivers, but the demand for these cutting-edge chips seems to be spreading again. Into phones, into connected devices, even into cars. It feels more broad-based this quarter.
Which probably gives TSMC more confidence this isn't just, a temporary AI bubble.
Precisely. They see it as a sustainable megatrend, fueled by technology leadership across multiple sectors.
Okay, that leads perfectly into their investment plans. C.C. Wei, the CEO, he said something quite direct on the earnings call. He said AI demand is more stronger than we thought 3 months ago.
Yeah, that's unusually bullish language, even for them.
So how are they putting their money where their mouth is? What's the CapEx situation?
Well, they're spending enormous amounts, but very strategically. They actually narrowed the CapEx range for 2025, tightening it upwards. Now it's US $40 billion to US $42 billion for the year.
40 to 42 billion.
Billion, yeah. And how they're spending it is key.
Break it down for us. Where does $40 billion go?
Okay, roughly 70% of it is going straight into advanced process technologies. That's N3 expansion, getting N2 ready, planning for A16, securing that future roadmap.
Got it. The core chip making.
Then about 10 to 20% is for specialty technologies. Think sensors, RF, things like that.
Right.
And the last piece, maybe 10 to 20%, but absolutely critical right now. That's for advanced packaging, testing, and mask making.
Ah, advanced packaging. Let's talk about that. CoWoS, right. Chip on wafer on substrate. That's the bottleneck everyone points to.
It absolutely is.
Can you quickly explain why CoWoS is so vital and why capacity is so constrained?
Sure. So think of modern AI chips like the big GPUs. They're incredibly complex. You can't just place the logic chip and the memory chips next to each other anymore. It's too slow.
Right.
CoWoS is a way to stack them vertically. Put the high bandwidth memory right on top of or very close to the logic chip using the sophisticated packaging.
Yeah.
It drastically increases speed and efficiency.
And everyone designing high-end AI chips needs it.
Pretty much. And the demand just exploded so fast that TSMC, even though they saw it coming, couldn't build capacity quickly enough. So yeah, the CEO confirmed capacity is still very tight.
Yeah.
They're working hard to add more in 2026 to close that gap.
So throwing money at packaging makes sense. But you mentioned something else, a deeper sort of structural change in their planning, Founder 2.0.
Yes, exactly. This is fascinating. Historically, TSMC would mostly get forecasts from their direct customers. The NVIDIAs, the AMDs, the Apples.
The chip designers.
Right. But now, for AI specifically, because the scale is just so enormous and the end users are so concentrated, they're talking directly to the customer's customers, meaning the big cloud providers, the hyperscalers, the Googles, Amazons, Microsofts of the world, the ones actually deploying these AI chips in massive data centers.
Huh. Why is that change so important? What does it give them?
It gives them, theoretically, a much clearer, much longer-term view of real demand based on actual application needs and deployment plans. They're trying to move beyond just chip design wins to understanding the full infrastructure build-out, looking maybe 2-3 years ahead.
So they can match capacity way more accurately, less guesswork.
That's the idea. It's a big strategic shift to try and de-risk these multi-billion-dollar fab investments, aligning capacity directly with the end market demand.
Okay, let's tackle a really interesting point that came up during the Analyst Q&A, this apparent contradiction.
The token versus revenue thing.
Yeah. The CEO says AI token consumption, basically AI usage and computation is growing exponentially. He literally said it increases exponentially almost every 3 months.
Right, explosive growth.
But then you look at TSMC's own projection for their AI-related revenue growth, and it's strong, don't get me wrong, but it's in the mid-40s% CAGR through 2029. That's not exponential. So how do you reconcile exponential usage with linear-ish, or at least not exponential, revenue growth?
Yeah, that's the million-dollar question, maybe the trillion-dollar question for the AI supply chain. And C.C. Wei, he gave a really insightful answer. He basically said, look, just because token usage is exploding doesn't mean our revenue has to grow at the exact same exponential rate.
Why not? If people are using exponentially more compute, shouldn't they buy exponentially more chips?
Not necessarily, because the chips themselves are getting exponentially better, or at least significantly better, thanks to TSMC's technology improvements.
Ah, okay. So the node shrinks. N5 to N3, soon N2. Each new generation handles way more computation.
Exactly. Node migration is key. A customer moving to N3 or N2 can handle vastly more tokens, more computation per chip, and often more efficiently in terms of power, too.
So TSMC sells fewer but much more powerful and much more expensive chips.
That's a big part of it. They capture the value through technological leadership and pricing power on those leading nodes. It's about selling performance, not just raw silicon area.
So the combination of TSMC making better chips and customers designing smarter systems using those chips, that meets the exponential token demand.
While allowing TSMC to grow revenue very strongly in that mid-40s range because they're delivering so much more value per chip, the efficiency gains absorb some of the sheer volume pressure.
Got it. That makes sense. It's about value capture through technology.
Precisely. And that ties directly into another comment the CEO addressed, something a major customer apparently said about Moore's Law is dead.
Yeah, that caused a stir. How did TSMC interpret that? I mean, they're the ones keeping Moore's Law alive, aren't they?
Well, C.C. Wei clarified it. He said the customer didn't mean transistor shrinking is over. I mean, TSMC is rolling out N2 with gate-all-around transistors and already talking A16.
Right, so innovation isn't stopping.
No. What the customer likely meant, according to Wei, is that just shrinking transistors alone isn't enough anymore to get the massive performance gains needed for things like AI.
You need more than just a better transistor.
Exactly. You need to look at the whole system. How do you integrate the chip, the front end, with the packaging, the back end, like Cobos? How do you manage power delivery, memory bandwidth? It has to be holistic.
And that's the Foundry 2.0 idea again.
That's the core of it, moving from just being a silicon foundry to being a systems foundry, enabling performance through both chip tech and advanced integration techniques, selling a complete solution.
Okay, we've got the tech, the demand, the investment strategy. Let's talk about the big operational challenge. Building factories all over the world, this global expansion, it's expensive, it's complex. How's it going?
It's moving incredibly fast, driven by geopolitics and customer demands for supply chain resilience. Look at Arizona in the U.S.
Yeah.
They're actually speeding up the capacity expansion there. And crucially, they're planning to upgrade the technology going into Arizona to more advanced nodes faster than they originally planned.
Why the change?
Strong AI demand, specifically from U.S. customers. They need leading-edge capacity on U.S. soil. TSMC even secured a second big plot of land nearby, suggesting they're thinking about a whole cluster of fabs there long-term.
Wow. Okay, Arizona's accelerating. What about Japan and Germany?
Japan, the Kumamoto fab, that one's already humming. Started volume production late last year, 2024, and the CEO said it has very good yield. That's impressive speed.
And Germany?
The Dresden specialty fab, focusing on automotive and industrial chips for Europe, that construction has started and is apparently progressing smoothly. So all systems go on the global front, it seems.
But this can't be cheap. Building and running fabs outside Taiwan, which is like the super efficient, optimized hub, that has to cost more, right? What's the financial hit?
It absolutely costs more, and TSMC is upfront about it. They talk about margin dilution. It's a deliberate strategic cost, they say.
How much dilution are we talking?
In the near term, second half of 2025, they expect the hit to gross margin from ramping these overseas fabs to be around 2%.
Okay, 2%. Manageable, but not nothing. What about longer term, as these huge fabs fully ramp?
They're guiding for maybe 2 to 3% dilution in the early stages over the next few years. But you have to see it in context.
What's the context?
The context is what they get for that 2-3% margin hit.
Yeah.
They get geopolitical diversification. They satisfy key customer demands for regional supply. And they unlock potentially huge government subsidies and support in the U.S., Japan, and Germany.
So they're trading a couple of points of margin for strategic security and market access.
That seems to be the calculation. It's a long-term play. And despite that dilution and the massive capex, they're still incredibly profitable and financially sound.
Yeah, they reiterated their commitment to a growing dividend too, right?
Wow.
Approved NT $5 per share, payable early next year.
Exactly. It signals confidence. So wrapping up Q3, it really boiled down to two things, didn't it?
What are they?
One, incredible technological depth. 74% advanced nodes driving the revenue. And two, this revamped Foundry 2.0 planning approach, engaging directly with the hyperscalers, all driven by this massive conviction in AI's future.
And that future tech is already taking shape. N2 is basically here, volume production starting this quarter, Q4 25.
Yep, with gate-all-around transistors. And then A16 hot on its heels for the second half of 2026. That's the one with the super power rail, backside power delivery.
Right, moving the power lines to the back of the chip to free up space on the front for more transistors and better signals.
It shows they're relentlessly pushing the boundaries, even if the definition of Moore's Law is evolving towards systems.
So for you listening, what's the big picture here? TSMC is seeing AI demand that's even stronger than they expected. They're boosting spending, changing how they plan capacity, accelerating global builds. They're all in.
All in on managing this explosive growth through that Foundry 2.0 system-level approach.
Which brings us to the final thought. We heard the CEO talk about exponential token growth, and we heard about the need for system-level innovation beyond just shrinking transistors. We also know building globally costs more, that 2–3% margin dilution isn't going away soon.
Right, those are the tensions.
So the question for you to ponder is, how much more investment, both in R&D for things like A16 and superpower rail, and in potentially lower margin global factories, will it take for TSMC to actually deliver the performance needed for exponential AI growth while navigating those costs and the undeniable geopolitical risks of spreading out?
Can they maintain that tech leadership and manage the complexity and cost of becoming a truly global manufacturer at the leading edge? That's the tightrope they're walking.
Thanks for listening to Know What You Are Investing podcast, Decode the World's Top Companies.
What they do, how they grow.
Why it matters. That concludes our TSMC third quarter 2025 earnings recap. Thank you for listening to Know What You Are Investing podcast, where we decode the world's top companies. If you found this episode helpful, follow the show and share it with an investor friend. See you in the next episode.